Before starting the video, click the subscribe button and turn on the notification bell. In today's lecture, we will discuss about what is depreciation, how many methods are there to calculate the depreciation, and calculation of cost of machine. So, what is depreciation? As per International Accounting Standard, depreciation means the decline in the value of fixed assets due to wear and tear. Here, the term wear and tear means that it is due to the nature of an asset. Means if the machine gets rusty, so if it has the value of something today, it will not have the same value in the next year. Means it will be depreciated, it will lose its value for being old. So that means the depreciation. Kindly note that the decline in the value of by any other mean, if the asset gets damaged or it is destroyed, it is a loss, not depreciation. But decline in the value of fixed assets due to wear and tear by its nature, that is depreciation. Salvage value, residual value, scrap value. These all are the name of one thing. Salvage value, scrap value, residual value means the value which will be left over at the end of the life of the asset. Depreciable cost. Depreciable cost means the cost to be depreciated. So, the formula to derive the depreciable cost is cost minus scrap value. Here, why we are deducting the scrap value? Because it will be left over at the end of the life of the asset, and rest of the cost shall be fully depreciated and it will be zero. So that is why we are deducting scrap value from the cost at the start of the depreciation. Book value, written down value, or carrying amount. These all are the name of a single thing, and this means the value for the time being. In other words, the value which is for the time being at the year end where you are standing. So the formula to derive the book value is cost minus accumulated depreciation at the end of the year where you are standing. Means if you are standing at the end of year 2 and you want to calculate the book value, so you will have the cost minus the total depreciation till the year end where you are standing. Now let us have a look at how to calculate the cost of assets. How to calculate the cost of asset and what items are to be included in the cost. While calculating the cost of asset, you should bring into notice that following items shall be included in the cost, and if the expense does not relate to the following conditions, then it shall be expensed out as normal expenses and it shall not be included in the cost of asset. So on number 1, cost to purchase the asset. Then number 2, cost to bring the asset to the premises, means transportation cost and other costs which are included in the transportation. Then the cost to install the asset and the cost to operate the asset. If any of the expense relates to the following 4 situations or conditions, then it shall be included in the cost, otherwise it shall be expensed out as normal expenses. Following are the expenses that should be included in the cost. Number 1, purchase price. Number 2, transportation inward. Transportation inward means transportation to the premises of the company. Then import duty, Insurance in transit. Insurance in transit and import duty are important items to be paid while transporting the machinery to the company. Then installation cost, then professional fee, test run cost, and sales tax non-refundable. All these are expenses which meet the four conditions so that they are included in the cost of the asset. Items that should not be included in the cost and should be expensed out as normal expenses. Fire insurance. Now, fire insurance does not have to do anything with purchasing the asset than to bring it through the premises in transportation, then to install the asset, and then to operate the asset. So it has nothing to do with all these four conditions. Therefore, it shall be expensed out and not included in the cost of asset. Then sales tax refundable. If you will get a refund of your sales tax. Therefore, it shall not be included in the cost because it has nothing to do with all four conditions. Then transportation outward. Now this means when you're about to sell the asset or you're about to get the asset out of the company, so it has nothing to do with those four conditions. Therefore, it shall not be included in the cost as well. Then any minor repair cost while installing the asset. So the minor repair shall not be included in the cost of asset. Now let us take a look on the question of calculation. Now we have a question that list price is 5,000, trade discount is 200. The seller makes an offer. If the company pays within discounting period, it shall be given a discount of 2%. The company paid within discounting period. Import duty is 900, transportation in is 100, insurance in transit is 200, installation charges 150, professional fee 650, and fire insurance is 250. Now let's have a look at how and which expenses shall be included in the cost. Now the things to know before starting the calculation are list price. List price means the price which was quoted by the seller or the price which is tagged on the asset. Then trade discount. Trade discount means the discount which is availed at the time of bargaining. Invoice price. Invoice price means the actual price on which you got the asset, on which you purchased the asset. Then cash discount means the discount which is availed by paying early. So there is a difference between trade discount and cash discount, and you have got understood that trade discount is availed at the time of bargaining and cash discount is availed by paying early. Now let's have a look on the solution of question. List price 5,000 less the trade discount which is availed at the time of bargaining 200. Then we will get the invoice price on which we purchased the asset 4,800. Then we will add the expenses relevant to all those four conditions. Number 1, import duty, we will add it. Then insurance in transit 200, transportation and 100, installation cost 150, and professional fee 650. Now professional fee has to be added in it because without the expertise availed by the professional you cannot operate any type of asset. Therefore, it is necessary to avail the services of professional so that you may operate the asset. Therefore, it shall be added. Now the total cost invoice price plus all these expenses shall be the total cost of asset. Methods to calculate the depreciation. There are 5 methods to calculate the depreciation. Number 1, straight line method. Number 2, unit production method. Number 3, working hour method. Number 4, diminishing balance method. And number 5, sum of the year digit method. Now let's have a look at how to calculate depreciation under all these methods by watching the calculation and the formulas used under these methods. Before starting the calculation, you must have to keep in knowledge that depreciation is calculated at the end of year and not at the start of the year. Calculation under straight line method. So the formula of straight line method says cost minus salvage value divided by total useful life in years. Now let's have a question. Suppose we have an asset which cost 1 million and a salvage value of 80,000 and a total useful life of 10 years. So we shall deduct the salvage value from the cost and divide it by estimated life. Therefore, we will get the depreciation expense. As you can see, in 2020 we are getting 92,000 and accumulated depreciation means the total depreciation. So total depreciation till year 1 is 92,000. Then coming to the year 2, same cost and salvage value shall be deducted, then it shall be divided by estimated total useful life. Then we will get the depreciation expense as 92,000. Then accumulated depreciation for 2 years, the first 92 plus the second 92, it shall be 184,000. One thing you can see in this chart that 1 million minus the same salvage value, cost will be same and the salvage value will be same, divided by the total estimated life. So the depreciation expense in this method shall remain constant throughout the life. Calculation of depreciation under unit production method. So first of all, we will find out per unit depreciation, and the formula is cost minus scrap value divided by total life in units, and then we will multiply it by units produced within a particular year for which you want to have the depreciation of. Now let's have a look on unit production methods calculation. Depreciation rate is cost. Say we have an asset and its cost is $62,500 and the salvage value of 2,500, then divided by the total units which it will produce is 100,000 miles. Then if we solve this fraction, we will get the answer of 0.60 per mile. Now let's depreciate it. Suppose that it produced 30,000 miles for the first year. Then 30,000 into 0.6, we will get the answer for first year depreciation, $18,000. Then coming to the next year, it produced 50,000 miles. Now 50,000 into 0.60 will be 30,000. Now coming to the year 3, 20,000 miles. Now 20,000 multiplied by 0.60 and it shall be equal 12,000. Then you can see the column of accumulated depreciation. In the first year it is 18,000, Then in the second year it is 18 plus 30, 48,000, and then in the third year 18 plus 30 plus 12, $60,000. Now let's have a look in the column of book value. In the first year, the book value remains the same because the asset is not depreciated. Then, at the end of the first year, asset cost minus accumulated depreciation 62,500 minus 18,000, the book value shall be 44,500. Then, cost 62,500 minus 48,000, the book value shall be 14,500. Then cost minus accumulated depreciation of year 3, 60,000, then the book value shall be 2,500. Now the assets had only this life, and you can see that book value is equal to the residual value, the value which is left over at the end of total useful life of the asset. Calculation of depreciation under working hour method. Now, per hour depreciation is calculated by the formula cost minus scrap value divided by total useful life in hours multiplied by total hours worked. Now let's have a look on its calculation. Now let's take an example that expected working life of machine is 100,000 hours. Cost of machine is 58,000 and scrap value of the machine is 3,000. Now hourly depreciation rate is cost minus scrap value divided by total life of asset in hours. You will get per hour depreciation as 0.55 paise per hour. Depreciation in 2004. Let's say the machinery worked 1200 hours in year 1. Then 1200 into 0.55 is equal to 660 hours in year 1. Then in year 2005, 1350 into 0.55 per hour depreciation. Then we will get the depreciation in year 2005, 742.50 rupees. Calculation of depreciation under diminishing balance method, reducing balance method, or written down value method. These are all the same, but by WDV, written down value, you must know that it is another name of the book value. So coming to the formula, cost minus accumulated depreciation means book value multiplied by rate. Now let's have a look on its calculation. So book value at the start of 500,000. As we have discussed before, that depreciation is calculated at the end of the year. So at the start of the year 1, there will be no accumulated depreciation to be deducted from the cost. Therefore, the cost shall be multiplied by rate. For example, the asset is purchased for $500,000. Then it shall be multiplied by the rate of declining balance method. Then we will get the depreciation at the end of the year 1, 200,000. Then the total depreciation at the end of year 1 shall be the same, but the book value will be cost 500,000 minus $200,000 accumulated depreciation equal to $300,000 at the end of the year. Then on the second year we shall have $300,000 because we have discussed before, the formula says that cost minus accumulated depreciation multiplied by rate. So on year second we will have 3 lakh multiplied by 40%, and we will get $120,000. Then this shall be added in the first year depreciation, and we shall get the accumulated depreciation for 2 years equal to $320,000. Now 3 lakh shall be deducted, or you can say that 500,000 shall be deducted by the accumulated depreciation of year 2, and we will get the answer at the end of the year 2, $180,000 as a book value. Calculation of depreciation under sum of the year digits method. Now this is the last one, and let's have a look on the formula. Cost minus scrap value multiplied by factor. Now what does the factor means? Factor means the sum of the years. Suppose an asset has a total useful life of 5 years, then we shall add 5 plus 4 plus 3 plus 2 plus 1, sum of all the years equal to 15. Now let's have a look on an example of sum of the year digits method. We have asset cost of $50,000, assets life of 5 years, and a salvage value of $10,000. Then how we shall calculate the depreciation under this method? On year 1 we have depreciable cost minus salvage value, 50,000 minus 10,000, 40,000, multiply by 5 over 15. Now we know that 15 is the sum of year, it is the total factor, and 5 indicates that asset is left over for next 5 years. Then we shall have 13,333.32 depreciation for the year. Then on second year we have 40,000 depreciable cost. Then the asset is left over for 4 years now, so we shall change the factor from 5 over 15 to 4 over 15, and we will get the depreciation for the year 10,666.68. Then on year 3, 40,000 into, now the asset is left over for next 3 years. Now 40,000 multiplied by 3 over 15, and we shall have $8,000. Now this is the method used for calculating depreciation under sum of year digits method. Hope you have got the idea about the depreciation. If you have any other question, you can put into the comment section, and that answer shall be entertained by the videos. Till then, good luck.